We're now going to look at transactions that reduce sales and accounts receivable to their proper amounts. Let's start with discounts. And I first want to distinguish between two main categories. They differ both in their nature as well as how we account for them. First, there are trade discounts, also called price discounts. These are easy. A distributor might get some percentage discount off the list price because they're buying in bulk. Or maybe price discounts reflect negotiations between buyer and seller. Importantly, the amount of a trade discount is known at the time of sale. So this all factors into the transaction price of the contract, and there's really nothing fancy to account for. The revenue that hits the income statement is already net of the trade discount. Now, sales discounts are different. They're also called cash discounts, and these reflect incentives for timely payment. You're probably already familiar with the accounting lingo, like terms of 210 net 30, which means any amounts paid within 10 days get a 2% discount off of the total. But after that 10-day window has passed, any remaining balance must be paid in full, which is due 30 days after the date of the sale. This is the company's way of encouraging customers to settle their bills quickly, which improves working capital. The uncertainty here is whether the customer will actually take advantage of the discount. So we have a choice in how to record it. And there are two acceptable methods under US GAAP. The gross method is what it sounds like. You record the full or gross amount of revenue up front. Then if the customer pays within the discount period, you reduce revenue using a contra revenue account called sales discounts, which serves as reduction to sales revenue. You're not assuming the customer will take the discount. You record the full amount and adjust only if they actually pay early. The net method works the opposite way. You initially reduce the revenue by the amount of the sales discount. You're assuming the customer will take advantage, and if the customer pays after the discount period, you reverse that and recognize additional revenue for the discount they forfeited. Importantly, both of these methods result in the same financial statement effects, but it's likely that a company will pick the method that better aligns with their customers' behavior. Now let's talk about sales returns. Under the revenue recognition framework, when customers have a right of return, this is not treated as a separate performance obligation. It's better thought of as a special case of variable consideration. And this can be an important adjustment to your top-line revenue. It's important that companies don't just recognize revenue at point of sale and then ignore the possibility that the customer will send the stuff back. Specifically, we need to account for both actual returns that have happened and estimated future returns. So at the point of sale, if you know that some percentage of items will be returned, you reduce revenue for that estimate. Then, at year end, you estimate what returns will happen in the future and set up a refund liability account. You also debit an inventory account for the estimated returns based on the cost of those goods. In this way, we've made adjustments to revenue, but also to the inventory account for what we expect will be returned. Sales allowances are a little bit different. This is when you reduce the selling price because of minor defects or issues, but the customer keeps the goods. Maybe the shipment arrived with some boxes slightly damaged, or the paint color is slightly off from what was ordered. You can either take the merchandise back, or you could offer to just reduce the sales price. If the customer chooses to keep it and you reduce the amount they owe, that is a sales allowance. It's a credit to the customer's account without requiring a physical return. This is important because it is still an adjustment to revenue, but inventory and cost of goods sold are unaffected, which makes sense because the company doesn't get the goods back. So, bringing each of these topics together, I want you to know that we're looking at three main categories of contra revenue accounts. When you look at a company's income statement, the sales revenue figure you see at the top is already net of these reductions. Specifically, I'm referring to sales discounts, actual and estimated returns, and sales allowances. The company doesn't show you the gross figure and then list all of these deductions. It starts with that net number. And that's why when you're analyzing financial statements, you need to dig deeper, especially into the footnotes, to understand what's happening with returns and discount behavior. A company with high returns has a very different business model than one with low returns, even if top-line revenue looks the same. Now let's transition to the subsequent valuation of accounts receivable. And a lot of this should be review from what's been covered in previous classes and even earlier this semester. We start with the reminder that just because you're entitled to receive payment doesn't mean that you will be. Credit losses are an inherent cost of selling on account. Customers can experience their own cash flow problems, they can be insolvent, they can even dispute charges. And accountants have two methods for dealing with this. The direct write-off method is a straightforward approach. You wait until you make the determination that an account is uncollectible, and then you write it off. You record a bad debt expense and reduce accounts receivable. For many small businesses that use the cash basis of accounting, and especially where credit losses are minimal, this is a perfectly acceptable method. The problem is, this approach is not GAAP compliant when bad debts are material to the financial statements, primarily because it does not provide financial statement users with timely information about potential credit losses. That's why the allowance method is required. With this approach, you estimate upfront how much of all your outstanding receivables you won't be able to collect. You set up a contra asset account called the allowance for uncollectible or doubtful accounts. And this account reduces the gross accounts receivable to show a more realistic net receivable balance. Gross AR, that's what a company is legally entitled to receive. But net AR is what the company actually expects to collect. And the counterpart to setting up the allowance is the bad debt expense that hits the income statement. So, how do we estimate bad debts? The Accounting Standards Codification requires companies to use the Current Expected Credit Loss Model, or CECL. The idea here is that you look at a variety of factors: your customers, your historical experience, economic conditions, credit information, any reasonable variable here, and then you estimate the size of your expected credit loss. And as seems to be the theme for today, there are different approaches. Some companies use a percentage of credit sales. If they know that historically 2% of credit sales turn to bad debts, they'll record 2% of this period's credit sales as bad debt expense. This is income statement focused because it uses income statement figures as the primary input and output. It generates an expense that should be commensurate with the revenue it's attached to. However, most companies use some percentage of ending accounts receivable. If they estimate that 5% of the current AR balance will be uncollectible, they'll make an adjusting entry to ensure that the allowance will be 5% of the ending balance. This approach is balance sheet focused because it makes adjustments with accounts receivable, a balance sheet account, in mind. And overall, we've now seen various ways that we make subsequent adjustments to revenues and receivables. Remember, we've got a bunch of contra accounts, contra revenues like sales discounts, returns, and allowances that serve as a reduction to gross sales to get us to that top line, net sales revenues on the income statement. And as we just observed, accounts receivable is also adjusted for estimated uncollectible accounts. And taken together, these all serve to show how we as accountants care more about presenting substance over form. Not presenting financial statement users with what the company deserves to get, but what we actually expect will happen.